All right, everybody. So today's lesson is going to be on basically the execution of trades. You have these elements, you know what you're doing, and it's really important because a lot of folks, they try to trade for a long period of time, and they just can't do it, or you see a lot of analysis, but the execution is what's required, and the reason why is the execution has to be broken down. So a lot of folks, they just don't get to the point where the trade execution is broken down in a systematic, methodical way, and that is holding people back from being able to basically trade and focus too much on the analysis and not enough on the execution. And when you ask about the execution, it's a very vague answer. Like, if this does that, then it's my trigger and I'm going to take a 3-to-1 or 2-to-1. Or, if the trend is up, and then this happens. So it's very vague, and this is a major problem because until all these elements, these are the basic elements right here that I'm showing. These basic elements are really questions or problems that need to be solved within the trading plan, and without it, it's not possible to execute, because you have at least not possible to execute consistently, because you're always going to think, what should I do, without knowing in advance what I should do, like trying to figure it out during the trade. And if that happens, when you're trying to figure out what to do during the trade, this is when fear comes in, and FOMO and fear of loss and fear of being wrong will screw up the trade. So the elements of fear will enter. For example, let's say you're in a winning trade, you see a lot of profit, and if you don't have this stuff defined, what will happen is the fear of it coming back down or something, it will make you move the stop too close. And then as soon as you move it too close, you'll get taken out of the trade, and then see it reverse and go up, and ask yourself what happened. What happened was that this stuff wasn't thought of in advance, and if you're doing it on the fly, it is a recipe for losses and self-sabotage. So I'm just going to go over this. This is it. These are the elements. All right, this is trading. This here is trading. It's the trade execution, which is totally different than quote-unquote analysis. And this is the difference between traders who know what they're doing and those who are trying to figure it out. This is it. This is the blueprint. So I'll just go over it. And first is direction. So the idea of, do I go long and short? It's very simple and straightforward, right? Do I go long or short? But you see how important this is when folks are always counter trending or doing things that, and you can counter trend, but the idea is you need to know the direction that the market is moving in and trade with that first and foremost. So direction, how do you do it? For me, I have an indicator that is buys and sells. So for me, it's just, a higher time frame or a higher box size or a higher brick size. What does it say, the higher time frame? What does the higher time frame say? Is it on buys and sells? All right, that's it. That's simple as that. For you, it may be something else. You may see some, is the, 20 greater than the 50 and 50 greater than 100, or maybe something. Is it uptrending? Whatever it is that you're using on a higher time frame. Very, very important. Why? You must see the context, and the context is always at least, the higher time frame, not the lower time frame. The lower in context with the higher time frame. This is the way you do it. Otherwise, you won't have clarity. You won't have all the minimum amount of data to make an accurate decision. Second is trade location. where do you trade? So for me, I'll show later on how I do it. But you need to have trade location. This is such a big problem for individuals, specifically for folks who are using signals. Because in most situations, signals are conditional and not based on trade location, making them subject to a high degree of randomness. This is the reason a lot of signals don't work. This is the reason why the hit rate is bad, because they're based on conditions. If A, then B, then C, then D, then signal. But that is subject to one time frame, and it is not based on high time frame trade location, giving you a myriad of signals that is going to have high degree of randomness. They are conditional. Those conditions are on a very small time interval, and those conditions are subject to easily change. And they're not based on trade location. This is I can't explain how important this is. This right here, folks will, trade location is so important. I think it may be equally important as trend. That's how important it is. All right. If you don't get the location right, everything falls apart. In fact, not only does whether it's going to work or not, but if it does work, the amount of profit, the reward, is going to be skewed. It's going on badly, and the risk is also going to be skewed badly. So trade location impacts probability of working. It impacts the amount of reward and the amount of risk and its ratio one to the other. So this is like, and if you don't get this right, even your perception of the market will be incorrect. That's how crazy this is. This trade location can impact the ability to see the market correctly. This is like super important. So trade location, and for me it's just a test. But believe me, it gives me a lot of perspective. After you get this right, you start seeing the market clearer. Without this, there's a lot of I don't know how else to explain it, but your vision of the market is off, you know, and it can create lots of screw ups. All right, so trade location, for me, I figured out how to do it simply, but this is the game changer. If you get this right, trade location is the game changer. Also should be higher time frame. Tesla buys and sells. The setups, I mean, there's so many. You could have like a base and then breakout. It could be a change of behavior. These are just two of them. Other folks use different, different stuff. But a breakout, and this would be on the lower time frame, right? So in the direction of the higher time frame and in the location of the higher time frame, looking for a lower time frame, either base and a break or some change of behavior, right? And then the trigger. The trigger so the setup is the breakout, but what is the trigger? So it's different. I'll just give an example. So here you had a base, and here you had a breakout, right? So now, is that the trigger? No. It comes back right, to test, and then you might look for a trigger. So whatever it is, it could be something over here, it could be a green bar afterwards, it could be some type of candle pattern, right? Whatever it is that you're looking for. So that trigger on a lower time frame whatever it is, reversal at whatever, at the test or something, whatever it is that you use. The entry is different than the trigger because it gives you the exact price. All right, now I use whatever I use. It could be, do you get, okay, so let me explain the entry. So once this happens, do you get in at the close of the bar? Do you get in on halfway back of the bar? So, you know, do you get in at the open of the bar? So some will say 50% or 68% of the bar, you know, or the prior bar high, right? Prior bar high or 50% of the bar. And then where's your initial stop? Where's your stop? The initial one might be below the base. All right, it might be there. So that's the initial one will be like the high or low, right? Now here's the thing. If you're, now you want to cut a risk as quick as possible as soon as you see it work. So this is this initial stop. When I'm entering, for example, right, entry here, entry, when I'm entered, the stop is here. After it works, meaning I have fall through, then how will you move the stop? How will you move the stop? It will go here. Okay, so it's still not a break even, but this is how you cut the stop. Let's say it's when you have follow through, meaning your trade is working. So you cut the stop. And then, when do you go to break even? When you take out the high. When it does that, we go to okay? So this right here has to be defined. In the way you cut the risk from initial stop to moving the stop right under the area, you know, the reversal, and then finally to the break even. And doing that really sharp will ensure that if the trade fails, you get out at break even. Or you take a much smaller loss than the initial stop because you moved it as soon as you saw follow through, and you get a very small risk. And this is how you basically get big reward and little risk. All right. So the point of today is really to make sure you have these elements right here identified. Okay, the direction, the trade direction, the trade location. I've already harped on. I don't harp on how important this is. It not only makes sure that you have probability on your side, it also makes sure You take out some of that randomness from from conditional based signals. It also makes, because you've seen like the Wyckoff, they have springs and up thrust everywhere. Half of them are not going to work if you don't have trade location, period. All right. So they also put trade location also gives you really good perspective on how the market is moving and the direction it's moving in, and it'll just change the way you see the market. It will totally change the way you see the market if you have this. And then finally the setup and all that. Okay, now I'm just going to show a trade. All right. So here's crude on the top left-hand side, right? So the market over here had a breakdown. It had a base, and then it broke down right here. Yesterday it tested, and today, guess what? It retested. Okay, so it's retesting the break, right? So this market is on sells. Where's the trade location? Right here. I have that orange bar thing, orange line. So it goes back into my location, and it's testing, so it's in the trade location area. And then finally on this lower time frame, or lower box size, it starts moving sideways. So what do you know? Sideways is, chances are I'm looking for distribution. So where does it happen? Right here. One, and another one right here. That's 4,300 and 4,200. So 8,500 in just those two boxes. 8,500 contracts were sold here and here, regardless of how much was sold in the background, right here, here, and it broke. Okay, bingo. What is this? This is my trigger. No, this is my signal. So I have what I'm looking for, trade location, I have the signal, and then I just execute whatever else I explained. And so this was also the SOT and the change of behavior occurring in that location, trade location. Very important. Once you catch it with a low risk, get a nice fat move. All right. All right. And regarding profit taking, I know I mentioned the styles of profit taking and the stop movement I mentioned. It's very important to get that right, because if you mess that up, if you play around with the stops, you will be taken out of a profitable trade for sure. Even though you got everything else right, you'll be taken out. And also, if you keep moving the profit target, if you do two things while you're in a profitable trade: one, if you don't know how to move the stops, or you're just moving them too frequently, or the second is you move the profit target beyond where you initially thought and start messing with that, it will mess up the trade. Because when the stops and the profits targets are moved, the underlying emotion is what? If your stops are being moved, it's because of fear of loss. If your target is being moved, it's because of fear of leaving money on the table, basically a function of greed. And when those two demons enter, fear and greed, they will ensure that you mess up the trade. All right. So that's what's really going on behind these actions of not knowing, stops and targets. And the problem is that if you don't have this written down, and you're doing or thinking as you're in the trade, then you're going to be subject to fear and greed instead of logical thinking processes. And they will always override the logical thinking processes. Fear, greed, some hope, whatever, these emotions are stronger than logical thinking processes. They will override them, and they will mess up the trade. Anyway, thank you. Have a good day. Bye.